It's a tale of two banks this Friday as JPMorgan tried to put behind it the big trading crisis and a decline in earnings. For the second quarter, Wells Fargo came in with a big jump in profit on the back of some healthy mortgage information. We'll start with Anthony, who's looking at JPMorgan. You know, Jamie's obviously saying that it's all behind us now.
That's what he's trying to say. Yeah, they said, look, we've so far lost $6 billion. We could lose, in the worst case scenario, up to another $1.7 billion.
This is all from the CIO trades, the London
from
whale.
those dodgy derivatives trades,
Yep.
exactly. We've taken all these steps to make sure that the same thing doesn't happen again. So we've gone. I mean, they actually did quite a good presentation about what went wrong. So it went through everything from even for the first quarter. They said that we're actually looking at it. We're not happy with some of the marks the traders put on. So we're shifting.
So they had to go back and restate first quarter earnings.
But all they're doing is they're shifting some of the losses they would have taken in the second quarter into the first quarter. It doesn't look good at all, but at least from a transparency perspective, it's something they could have just kept silent about it. So I give them some credit for it, although it does also raise the prospect that their risk management really was terrible in that unit for a very long time.
But I mean, this is the issue though too. I mean, it's not just the losses, right? But that, you know, again, this idea that the marks were wrong, right? The traders were actually valuing these.
No, and it will go, and that's why, you know, this doesn't really put it behind them in the sense that this now reopens some of the trust issues.
Yeah,
and we know whether investors, customers, all that.
One of the most worrying things actually was what they did with their value at risk numbers. Now this is a backward-looking model that tries to capture what you may lose in certain scenarios, and everyone's focusing on this, even though everyone kind of agrees that value at risk models are kind of useless.
But it's the one that
everyone's focusing on, and actually the unit seems to have relied a bit more on it than they should have done. But the fear was that suddenly the unit had changed its model in the first quarter without telling anyone.
Right.
But it turns out actually they changed it in conjunction with the firm's overall model changing committee, or whatever they call themselves, last summer. So everyone knew about it, but worse, the data going into the VAR model for this unit was wrong. So I would definitely come down hard on Jamie Dimon and the bank. They really haven't allowed the blame to go further up the chain beyond Ina Drew, who ran CIO.
Right.
Now, look, I think they've done a good job at trying to get to the bottom of what's happened, but Jamie Dimon had Ina Drew reporting directly to her. They allowed this unit to be.
So there's got to be more repercussions. Let's quickly go into the Wells Fargo question. They haven't had any of these problems to deal with. They've had, they've been relying a lot on mortgages. They're the biggest mortgage,
Again, we're talking about lending, right? And I think one of the issues at JPMorgan, too, is you saw the investment banking going into this one part of the bank that should not have been there, right? I mean, again, dealing in derivatives. I mean, it's very, very, very rare that you hear Wells Fargo.
So Wells is more old-fashioned, but your sense is
they're very old-fashioned, but they're profitable. By market cap, they are now the biggest bank in the United States. I mean,
and they just didn't take the risks in this particular unit. And all banks can make these kind of losses and make these kind of screw-ups, but no other bank has gone into derivatives in their treasury unit in the big way that JPMorgan did.
And Jamie Dimon talked about it, that these trades had no business being in the CIO. They belonged in the investment banking unit. So
or nowhere.
Or nowhere. But again, you see this bleed through in some of these big banks of activities that shouldn't be there. And again, I think you look at Wells Fargo, and you don't see that because they don't have that history.
All right, well, we'll leave it there. The two big banks in the U.S. obviously clashing. Big question for investors on which one to choose. We will be back next week with more Breaking Views.